Hello and welcome to this video webinar brought to you by the Association of Corporate Treasurers, and today we are sponsored by Lloyds Bank. We're going to be talking about navigating interest rate markets. I am Sarah Boyce and I work for the Association of Corporate Treasurers, where after a number of years working in corporates I now provide policy and technical support. And I'm delighted to be joined by Nick Fletcher, who is the Head of Fixed Income Solutions at Lloyds Bank. Nick started his career as a chartered accountant with Deloitte and moved into banking, and he is a member of the ACT and has been supporting corporates with financial market solutions into their risk management problems for a number of years, so he has a wealth of experience to share with us. This webinar will be lasting for 45 minutes and we'd like it to be as interactive as possible. So please, if you have any questions, do submit them as we go along and we'll pick them up as we go. You'll find a button on your screen for you to submit the questions. And although you provide your name and company, we won't use those, so everything is anonymous. Please feel free to ask anything that you like. So moving on to the subject of today's talk, which is navigating interest rate markets. Since the financial crisis in 2007, markets have changed markedly. I think it's fair to say that. And today we'd like to talk particularly about how the interest rate market has changed. And so what I'd like to do is, first of all, if we could talk about the current state of the market and how we've got to where we are now. And then perhaps we could turn and talk about corporates and how the world has changed for them and the sorts of approaches perhaps they might like to consider going forward when they're looking at interest rates. It seems to me that, and anecdotally everybody tells us liquidity has dried up in the markets generally, and interest rates in particular. Now, is that actually correct, or is that just something somebody's been saying?
Thanks, Sarah. So let's just start by reminding ourselves, why do financial markets matter? Why do they help to play a role in a healthy, functioning economy? So, of course, financial markets do various things. They allow us to save for our children. They allow companies and governments to raise money, to invest in infrastructure and to hire people, to hire employees. They also help for efficient transfer of money between savers and businesses. And, of course, they also allow companies to reduce their risks and to hedge their risks. You're right, there has been a lot of focus on market liquidity and market volatility recently. I thought it would be quite useful just to start with a definition of what we define as market liquidity. So I would define market liquidity as the ability of a supply chain to respond to sudden spikes in demand.
Okay.
So let's look at some real life examples of that, just to put it in context.
That would be good.
So let's take the example of electricity, for example. So let's say if you go into your house and you turn on a light switch or you boil a kettle, you would automatically expect there to be enough electricity to do that for you. However, let's take an example of the middle of a World Cup final, where let's say England are in the World Cup final, which is
I'm not holding my breath.
Small probability, but if it did happen, you might find that at half time, 20 million people decide they want to go and boil a kettle to have a cup of tea. So would the electricity supply be able to cope with that spike in demand? Another example might be a milkman on his daily round of delivering milk bottles to a neighbourhood. He obviously has enough bottles to cover the pre-ordered milk, but he also carries a few in the bottom of his milk float for emergency supplies. So let's say Mrs. Miggins at number 23 decides she wants an extra few pints for her weekend. He can deliver that extra supply to her. So, but the problem might arise if, let's say, everybody in the neighbourhood decides they want 3 extra pints of milk. How does he cope with that extra demand? And the answer are he couldn't. So it's a measure of how deep the supply is. So in terms of whether the market liquidity and volatility is an issue recently, there's been certainly a lot of focus on that, including by the regulators. So the Bank of England issued a report last week called the Financial Stability Report. And in that, they have some interesting quotes, which I'd like to just refer to start with. So this is a quote from that report. So some markets appear to have become more fragile, as evidenced by episodes of short-term volatility and illiquidity over the past couple of years. Potential drivers of such episodes include a broad trend towards fast electronic trading and the impact of necessary regulatory reforms on the provision of market liquidity.
So there might be some debate as to how necessary some of these market reforms have been, but that's probably for another day.
Possibly. In fact, it goes on in that report to highlight 5 major risks to financial stability in the UK.
Okay.
Amongst them being buy-to-let mortgages, cybercrime, etc., those sort of pretty broad risks. And one of them was the fragility of the financial markets. So he sort of explains that by saying, despite such periods of intense volatility, there is evidence that market and liquidity risks may not be fully reflected in the prices of some financial assets. It's important that market participants recognise the underlying risks in different asset classes and price them accordingly. So it's been highlighted as a very topical thing to focus on for regulators and for the market. So what might help is if we go on to look at a few examples.
I think so, yes, please.
So the first examples we have here are of reduced liquidity in sterling interest rate markets. Mm-hmm. We have 2 graphs here for you, the graph on the left for swap rates and the graph on the right for swaption volatility. So what's noticed about the graph on the left, the sterling 10-year interest rate swap rate? So what we can see is there's been various occurrences of very large, relatively large moves in a short time frame over the last 18 months or so. Obviously, those red circles there are highlighting what we see as particularly large moves over short time frames, which are quite unusual. Yep. Moving on to the graph on the right, the sterling swaption volatility. What we can see there, this is a graph of volatility implied by option prices in the market over the month of March in 2015 this year. What we can see is one very big jump of 10 basis points in one day on the 15th of March. So that was caused by one single market participant going into the market, and the market obviously didn't have the depth to react to that position that was being put on to absorb the extra demand, if you like, on that day. So the market reacted accordingly with a big jump. So that's evidence of what we see by reduced liquidity and the effects it can have in these sterling interest rate markets.
Okay, and is it an unusual characteristic, the fact that graph has spiked up but then not spiked back down again? Because traditionally you'd expect to see sort of normalcy return.
I think you would. I think normally when markets follow fundamental economic rationale, they do return to where would be a good level, unless there's a mismatch in supply and demand, I suppose. So potentially you had the market participants not able to absorb the position that was put in by the market
participant. They're all one way, sort of.
Yeah.
Okay. Oh, interesting.
Okay, so let's move on to another example.
Yep.
So what we have here is a further couple of graphs demonstrating reduced liquidity and higher volatility. So the graph on the left-hand side shows outstanding notionals of interest rate derivative contracts. That is interest rate derivative contracts globally across all currencies, across all types of instruments, and that's from 1998 until the present day. So what you can see up until the crisis, you can see consistent growth in the market, quite considerable growth over the sort of 10 years previous to the crisis. Post-crisis, certainly stagnation in the size of the market, and in fact in the last couple of years quite significant reduction in the size of that market. Yeah.
It looks like it's completely stalled actually since the crisis.
Yeah, it's stalled and it's starting to come down, absolutely.
Yeah.
So what does that mean? What does that do to market prices? Well, so the graph on the right hand side is the daily changes in price of the 10-year sterling swap again. Okay. So what we can see, that's over the last 15 years again. So what we can see is moving from left to right over time, you can certainly see this is the difference in the maximum minimum price in any given day in the sterling swap rate. And you can certainly see that those changes in intraday price have increased quite significantly over the last few years.
Yeah.
There's also an interesting quote there at the bottom of that slide, which was from a speech from Mark Carney at Mansion House in June of this year. What he said was, the combination of new prudential requirements on dealers and structural changes in markets has reduced market depth and increased potential volatility. This process likely has further to run, particularly as the normalisation of global monetary conditions edges closer.
Okay, and I think that's why today's conversation is particularly relevant, is the fact that if the Bank of England are saying they think this has further to run, it probably does.
Absolutely. let's go on to look at one other quite specific event in a little bit more detail.
Oh, yes.
So this slide we now have up is talking about the flash crash in US Treasuries that took place in October 2014.
Mm-hmm.
So the flash crash is quite a dramatic name, obviously, but let's just talk about exactly what happened.
I like the name.
Yes.
It's good to name things.
It's good to name things, I agree. So on that day, we have there the top left-hand graph shows the yields in the 10-year US Treasury, so the 10-year US government bond on that day, and yields fell by 34 basis points on that day, which is a very large move. You can see it recovered soon afterwards, but it's a very big spike down on that day, as circled by the red circle. That movement of 34 basis points, in terms of what that represents historically, that compared to the historical range of movements in any given day, that's a 7 standard deviation move, which is pretty big. And in fact,
if you're interested in those sorts of things,
well, exactly. If that is interesting, and in fact, that in terms of probability of that happening, that represents 1/1000000000 of 1% in a normal distribution.
It's worse than the lottery, really, isn't it? It's a long way
yeah,
down that tail.
we could all be millionaires compared to that, absolutely.
Yeah, exactly. Yeah.
And in fact, what's quite unusual about that is there's no fundamental economic reason really for that event to happen.
Right.
I mean, if we look at other comparable moves of that size in the last 20 years in that market, we show these on the graph on the top right-hand side, in fact. So you can see that this is the last 20 years roughly of daily market moves in that market. The spike on the right-hand side of that graph is the flash crash, so the most recent event. And the horizontal red line is obviously the amount that yields moved in that event. There's only 3 times in the previous 20 years where yields have moved more than that event, and they are all fundamentally sort of some kind of economic event.
Okay.
What they represent are, in 2008 in October, there was a bailout of AIG by the Federal Reserve.
Right.
In March 2009, there was upsizing of quantitative easing by the Fed again. And in August 2011, the Federal Reserve made a statement about interest rates not moving until mid-2013, which again had a big effect on markets' expectation of where rates were going.
Okay, but as you say, all of those are real events. What caused the flash crash?
Well,
do we know?
Well, the Fed met quite soon after the event to sort of look into what had happened. They looked into some of the evidence and then released a report over the last couple of months into what they think happened. So if we just run through the events, it's quite interesting. It's essentially a combination of several circumstances happening all at once. So at 8:30 in the morning of that day, there was a release of some retail sales data.
Okay.
And actually, looking at the timeline of events on that day, the graph on the bottom of your screens is quite useful for looking at what actually happened. So that graph shows 2 hours of data in the morning, so between 8 a.m. and 10 a.m. That shows the number of outstanding orders in the US Treasury market. So in other words, a measure of the depth of liquidity, if you like, of that market over that time. So you can see up until 8:30, there's plenty of liquidity. And at the release of the sales data at 8:30, the liquidity drops, which is normal, and then recovers straight away afterwards, which is normal again. Now, the retail sales data that was released I think it was weak. So weaker than the market expected. So you would expect some drop in yields from the retail sales data, but it's
not. Retail sales comes out every month.
Yes, every month. So
it's quite often weaker than expected. So we don't get one of these every month.
No, exactly. So it's not in itself a particularly dramatic event.
No.
So I think to compound that, what we saw was that several market participants were positioned the wrong way.
Okay.
So they were expecting good news, if you like, rather than bad news. So hence, as they decided to cut their positions, the market moved a little bit further down.
Right.
Again, from the initial move. And eventually it started reaching levels where the electronic trading platforms that were providing liquidity to the market started reaching their daily limits and were being turned off. So what we saw is each of these events compounded the other, if you like. So the market started moving down, hit some limits, the electronic trading platforms turned off, therefore liquidity is reduced even further. So looking at that graph a little bit more closely, what you can see is the thickness of the the coloured lines gradually reduces as you move through time until 10 o'clock, until when you get to the actual peak movement in price, the liquidity is exceptionally thin at that time. So we have very thin liquidity and hence a very large movement in price over that time.
So this electronic dealing, which was part of this perfect storm, is that something that is becoming much more common in some markets? Is it something that corporates should think about getting into on their own accounts? How's that evolving?
Yeah, so I think electronic trading as a whole is becoming more common, certainly in certain markets that are order-driven markets like US Treasuries, equities, futures markets, for example. And where there is electronic trading, you tend to have a lot of algorithmic type trading funds operating in that sphere. I think generally the market is moving that way, and regulation is helping the market to move that way. And generally the electronic trading does help transparency of prices, does help liquidity. However, I think in times of stress,
I was going to say, when it goes wrong, it can go quite
possibly
wrong.
That liquidity can disappear.
Yeah.
Coming back to the sterling interest rate markets, those markets are generally quote driven by dealers, so they're not necessarily electronic markets at the moment in terms of swaps and options. But I think what we can say is that markets, even though they're not electronically driven, the prices of the electronic markets can certainly feed through to the other markets quite quickly.
So they're having an influence, even if it's not direct.
Absolutely.
On the
Absolutely.
markets.
Yeah.
Okay. And are there other markets that this lack of liquidity is showing up in?
There are, yes. Let's go on to look at another example.
Hurrah! I like this one.
So moving on to bond holdings and in particular corporate bonds. So this graph was actually published by The Economist earlier in the year in an article entitled "Vanishing Middlemen." So what this is showing is the total holdings of US corporate and foreign bonds in trillions of dollars. So there's several things that we can see from this graph. I think the first thing to point out is that the total of issuance of corporate debt is increasing quite significantly. So the total of the two lines, if you like, is definitely increasing quite significantly in terms of amount of bonds outstanding in the market.
And that's entirely consistent with all the messaging that you hear, that corporates are increasingly going to the capital markets rather than using bank markets. So that's not really surprising.
Absolutely. But just looking at the breakdown between those markets. So the two lines on there, so the dark blue line represents the amounts of bonds held by funds and pension funds and asset managers, etc. The light blue line represents the amount of bonds held by security brokers and dealers, in other words, investment banks. So looking at the light blue line, so the bottom line for a second, what we can see there is that peaked in pre-crisis in 2007 roughly, and has significantly fallen since then. I think roughly to about a fifth of the level that it was in 2007 in terms of outstanding notionals of bonds. The second thing that we can see from there, I think, is that the ratio of bonds held between funds and banks has increased dramatically. So again, in 2007 pre-crisis, the ratio was about 3-1, and that's now increased to roughly about 20-1. What that means in terms of the market's operations is that, if you like, the funds are more buy-to-hold investors. They buy the bonds because they like the bonds and they hold them on their account until maturity. Whereas the banks are not doing that typically on the trading books. They're holding bonds for short-term trading positions or to provide liquidity for clients who wish to buy or sell those bonds. So as the if you like, the emphasis on who's holding these bonds has shifted away from banks, there's less people in the market, if you like, to provide the liquidity.
Right, so this plays to the secondary market liquidity. I know we're getting slightly off topic here, but the secondary market liquidity issue that we see in the bond markets at the moment is basically because the banks aren't there for whatever reason, I'm sure we'll touch on it, that they're just not there to provide the liquidity.
Absolutely, they're finding it tougher to provide that, finding it a bit less cost effective to do so, due to regulations, if you like, and also due to increased use of digital platforms in the credit markets. Now, one thing that was pointed out by the Bank of England's report is well, okay, so far yields are quite low and credit spreads are quite tight. What happens if that reverses?
Yeah.
Credit spreads start increasing and funds are looking to sell their bonds or forced to sell their bonds even. In that scenario, what happens? Who will provide liquidity to the market? And that's one of the concerns that's being highlighted, absolutely.
Okay. Right.
Shall we move on to the final example?
Yes, that would be great. So foreign exchange.
So foreign exchange, and futures. So in fact, we have two graphs here again on this slide. The graph on the left shows the bid-ask spread in euro-dollar futures, and the graph on the right shows a Swiss franc spot rate. So focusing initially on the graph on the left, so euro-dollar futures, that is really the most liquid way to trade short-term dollar interest rate futures in the market. So traditionally has a very tight spread between the buy prices and the sell prices.
And you can tell that by the very flat blue line across the bottom then.
Yeah. Exactly. The sort of the most common state is where you have a very, very low line down the bottom. However, what we see is in times of turbulence or market stress, that spread does increase.
Yep.
So, that's due to volatility, if you like, prices moving around. And so in terms of using the market, it will feed through to higher execution costs. In terms of the FX graph on the right, so that was a very interesting event in January of this year. So the Swiss central bank decided to remove the ceiling on the currency.
Right.
Upon doing that, there was a very large movement in the Swiss franc FX rate.
I feel we need a name for this event. You know.
We can come up with something given enough time, I'm sure.
Yeah.
But again, it was a very large move. So, in fact, the Swiss franc appreciated by 28% in value in over a 20-minute period, which is very.
So you wouldn't have wanted to have to execute at that point.
Absolutely, absolutely. So the market was going nuts. And in fact, what we saw subsequent to that was that the Swiss franc again lost 19% of its value by the end of the day. So most of it was reversed. However, clearly there was insufficient depth in the market to absorb that event. Without moving the market significantly. That's also a consistent theme in other FX markets. So in terms of the increased volatility. So we looked earlier at movements in intraday markets in interest rates. So just to give you a flavour, the same thing is happening in FX markets as well. So euro dollar, for example, in the first quarter of 2015 versus a year earlier, the same period a year earlier, the average intraday spread, so difference between high and low price, was double what it was a year earlier.
Wow.
And in cable, so in sterling dollars, again, the intraday spread over that period was up 50% from a year earlier. So we're seeing a lot more moving around in markets, a lot more volatility, if you like.
Okay. So with all this extra volatility that we're seeing and the reduced liquidity, whichever way around it's being caused, what's driving the volatility?
That's a good question. So we have here the drivers summarised into four main categories. So we have regulations, reduced risk appetite, quantitative easing, and market innovation. So let's focus on each of those in turn. So regulations. So that is a mixture of bank regulations and wider market regulations. So the main regulations affecting banks are, I guess, that would include Basel III. So Basel III imposes a greater minimum capital requirements on banks, and it also encourages them to reduce the leverage in their books by what's called a leverage ratio. So the net result of that is really that banks are holding fewer assets, they're having to hold greater capital buffers against those assets. So they're looking at certain business lines as to whether they're profitable as well.
So that's changing their approach to business then effectively as a result of regulation.
Yes, regulations tended to make them more stable. Yeah. So another great example of that is the Volcker Rule.
Yep.
The Volcker Rule in the US, and there's a European equivalent ban on proprietary trading as well. So both of those regulations in the US and Europe are aimed to severely restrict banks' activities in proprietary trading. So in other words, trading on their own account, taking positions for short-term trading gain, if you like.
Yep.
So By restricting that, clearly that means banks are less likely to take positions in the market, also less likely to hold assets in the market. So all of those point towards reduction in liquidity in different markets, as we're seeing.
Okay.
The other regulation is worth noting is also the structural market reform regulation that's being enacted. So in the US, again, that's Dodd-Frank.
Right.
In Europe, that's EMIR. So these are aimed at making derivative markets much safer to take part in. So they introduce things like mandatory clearing for derivatives and increase margin requirements.
Right.
So increased collateral requirements, if you like,
Yep.
for trading derivatives. So what that means is the counterparties are much safer to trade with from a credit risk perspective, if you like. And markets are more stable to a certain extent in terms of the resilience of the counterparties involved in the markets and the credit shocks in those markets. But it does mean that the funding costs associated with the transactions has increased, and possibly you will see fewer dealers in the market because of the greater operational complexity.
Okay, and operational cost as well.
An operational cost, exactly. Yeah. So the next one we have there is reduced risk appetite.
Mm-hmm.
So I think this is again mainly for banks. So this has been driven partly by regulation, as you said, but also by strategic business decisions of banks to post-crisis to just reduce the risks they're involved in, to, if you like, to retrench into their domestic markets away from the global banking model to a certain extent. I mean, it's just a good statistic to back that up, I think, is that I saw a recent study that demonstrated that bank balance sheets in traded markets have reduced by roughly 30-ish% in the last 5 years.
Right.
So that's a good measure to say that, banks are pulling away from offering liquidity and taking positions.
Yes, they're becoming much more conservative, much more retrenched.
Yes, absolutely. Yeah, absolutely. The third one we have is quantitative easing.
Yes, now this. Explain to me a little bit about quantitative easing, because it's something I've often wondered about. Why? What's it actually done to the market? Has it worked? What happens when we unwind it? Do we have to unwind? Tell me, please. Sorry. There you go. And over to you.
Well, quantitative easing is essentially asset purchases by central banks.
Yeah.
So we have quantitative easing programs in Japan, the US, the UK, and now in Europe. Mm-hmm. The rationale for those programs is to allow funding to flow through to small businesses, etc., to stimulate growth in those markets by providing liquidity to businesses and small individuals, if you like, that should need it. With the aim of improving growth, if you like, in those economies. So, the effects of growth, I suppose, have been debatable, but what's for certain is that they certainly had an impact on bond prices. So bond prices have gone up.
Yep.
We've seen yields come down, credit spreads come down, which is of course great for corporates looking to issue. Yeah.
I'm not complaining.
No, exactly. I mean, on the opposite side of that is for investors looking for yield on their assets. I guess they're looking for more riskier assets to get sufficient yield. So what happens when QE is unwound is a very interesting question as well. So I think the risk obviously is the reverse happens. So whereas on entering QE yields come down. Asset prices go up. I guess the risk is that by unwinding QE, you see a falling in asset prices and an increase in credit spreads. So I think central banks are very cautious to make sure nothing too dramatic happens in that respect. I would say. Yeah. But in terms of unwinding, nothing's actually happened so far. So none of these economies have unwound any of their quantitative easing programs so far. Whether they will, when, or if they will, is debatable again.
Because presumably you don't actually need to. You can just sit on the bonds until they mature and just let it trickle back into the market that way.
Absolutely, that's one option. Yeah. So if a bond matures, you don't buy another one. You just let the program roll off naturally. That's absolutely one option. And in fact, Mark Carney made a reference to the QE program in the November inflation report last month, where he said that in terms of unwinding QE, nothing would be done until at least base rate hits 2% in the UK, which is quite a long way away.
We
would
think,
imagine.
yes, you would imagine.
Yeah.
Okay.
The last topic, market innovation, electronic trading, we've touched on that. Touched on that a little bit already. I think clearly it helps liquidity in the good times, but in times of stress, what happens to some of the liquidity is debatable.
Yeah. Okay. Just before we move on, volatility generally. One of the questions that's come through is volatility necessarily a bad thing? And actually, this probably leads us into the next sort of debate, which is, and if it is or isn't, what can corporates do about it?
That's a good question. It's not necessarily a bad thing. It's inevitable, if you like, function of having healthy markets that are moving around. So not necessarily a bad thing. I think, but I guess what you need to do about it to protect yourself if you need to.
Yeah.
So in terms of what we've seen so far, in terms of what are the implications for corporates, I think clearly we have larger intraday moves are to be expected, potentially wider execution costs as a result. You may see larger trades possibly moving markets in the way they haven't done before. And
market size is slightly different now, isn't it?
Yeah.
It used to be a lot bigger before you'd move a market, in any market, not just interest rates.
I think certainly, let's take the example of sterling interest rate markets. I think certainly the market size has fallen. So I think the market size now is typically for, say, a 10-year swap would be roughly £25 million.
If you're doing a 500 million bond, you're...
It's very big market size.
You're very mismatched,
And that has reduced. I mean, certainly 2 or 3 years ago, that was more like 50 or 100 million. Yeah. And what you also might see is fewer dealers around, I guess, to help with those positions as a result of some of the changes we've seen as well.
Yes.
So in terms of how that might change corporate strategies, so in terms of hedging their interest rate risk, one thing you might see is an extension of duration, so extension of fixed rate duration, and also possibly an increase in the ratio of fixed to floating mix of their debt. This is partly, I think, a natural occurrence that comes from the fact that many more corporates are borrowing via the capital markets. And of course, capital markets tend to be fixed.
Push it up, and longer.
And longer, compared to the bank markets, which are typically shorter and more floating. So the natural starting position before overlaying any derivatives is a little bit more fixed and floating, I think. So I think there's a natural tendency to extend the duration there. Also, possibly taking advantage of where the market yields are really low compared to where they've been historically. So you might want to take advantage of that.
Yeah, exactly. Fill your boots, I think is the phrase.
What we're also seeing is a little bit more pre-hedging of debt issuance.
Right.
So let's say you're a corporate and you're issuing a bond in a month or 3 months' time. You might look to manage the execution risk or the setting of the fixed rate on the day of pricing of the bond by hedging in advance. So you might do that via a swap or a treasury lock, for example.
Right.
You might do that all up front as soon as you know when you're issuing the bond, or you might look maybe to average in over a series of fixings just to spread the risk a little bit like that as well.
Just to manage if there is volatility in the market, just to give yourself a little bit more certainty. Because I know corporates are all about having the certainty. Absolutely.
I guess another theme we're seeing coming through is possibly dissociating the horizon of risk management from the horizon of the underlying borrowings. So and maybe rather than just looking at hedging your existing borrowing, maybe looking at future borrowings as well. So I think the context where we've seen that more helpful for corporates is where, let's say, they have naturally longer dated assets. So they would like to fund themselves against those assets for, let's say, longer term fixed rate issuance. Obviously, banks tend to have moved their borrowing from a little bit longer dated to more shorter dated recently. So you may have the position where you would prefer as a corporate to lock in rates for 10 years because you have certainty on your assets for 10 years. A bank may only lend to you for 5 years. So we're seeing a little bit more corporates thinking about hedging for a full 10-year maturity to match their asset profile rather than just...
And taking the mismatch on the hedge.
Taking the mismatch on the hedge. Yeah, so we're seeing that. Obviously, that removes some uncertainty as well in terms of the sort of future refinancing risk. Another area that we are seeing corporates think about is collateral arrangements. So I guess that reduces potentially the credit risk involved in transactions, reduces the capital requirements and the cost for transaction. And it may also be a useful use of cash if corporates have a fair amount of liquidity or cash on their balance sheet.
Yeah, I think there's still a lot of debate about exactly how collateral management is going to work for corporates. I think it's something that we're still trying to get the heads around.
Yeah.
Until the regulation settles down a bit and you know whether or not as a corporate you have or haven't been caught by the regulations. I think there's certainly a level of nervousness about how they're going to fund the calls for collateral.
Yeah.
Because that's going to take yet more liquidity out of not the interest rate markets, but out of the markets generally. Yeah. Which is another constraint that's appearing.
Yeah, absolutely. And funding collateral is clearly a concern for all market participants.
Yeah,
absolutely.
Exactly. But talking of managing execution more widely, how, given that you might want to hedge a 500 sterling swap bond, how would you go about doing that without moving the market, given that market size is now only 25, 50 million?
Okay, well, one good way of doing that is via a swap syndication process, which we have a diagram of here. So that would, let's say you have a very large bond to hedge and you would like to execute that hedge as a corporate with several banks. The way this process would work is you would choose one bank to execute the market risk for you, and that bank would discreetly manage that hedging of that market risk in the markets without moving the market too much, hopefully. And then once that's done, that hedge can be syndicated out to all the other banks. I guess the advantage of that from a corporate's perspective is you do get the discrete execution. You also get transparent pricing from mid-pricing, and you could get pre-agreed trading charges with the execution bank and pre-agreed credit charges with the other banks as well involved in that. So that's one way of managing execution risk. And as you say, due to the market size generally of derivatives falling, this is something that could definitely be useful for large trades, or even even for smaller trades where corporates have several banks they would like to execute the swaps with.
And are you seeing any sort of optionality being brought into this process? Are people looking at doing options rather than just outrights, or?
Yeah, absolutely. I mean, I think in terms of going back to the pre-hedging point, I mean, I think that makes a lot of sense to hedge with maybe swaptions or combinations of swaptions rather than just swaps. Absolutely.
Okay. Yeah. Okay. So finally, for many people that work in Treasury, low interest rate environments are all that they've known, and indeed in banks, because we've had low interest rate environment for what feels like such a long time now. Are there any sort of hints and tips or things that people ought to think about when what to somebody who's been around for as long as I have feels like the inevitable, and interest rates return to what you might describe as a more normal range?
Yes, so well, what is normal? What is the new normal? What is the old normal?
Well, exactly, yeah.
I think we can take some lessons from history. So I think firstly the lessons are the rates can be higher, obviously. I mean, pre-last few years, it was the norm for rates to be 5-6%, even higher. So that can happen, I guess, is the first lesson. So what's actually quite interesting to look at now, given that we're in an environment where the US is very likely to start raising rates. I think on the 16th of December, it's widely expected that the US will make the first rate hike.
Yeah, although I'm not holding my breath given their historical experience.
Well, this year, exactly, there's been a few false starts, so we'll see. However, it's quite an interesting time to look at what's happened in the UK in previous rate hike cycles. Yep. So we have on this slide four graphs. So these show 4 of the last 5 hikes in the last 20 years in the UK. What's happened around and about the time that the base rate was raised. So what we can see is that the greatest move in swap rates has occurred typically in the 6 months prior to the announcement of the rate hike. So the first graph in the top left is September 1994. So the thick green line at the bottom, if you like, is the UK base rate, and the purple line is the 5-year sterling swap rate. So what you can see is in September 1994, the base rate was raised, and the green shaded area is the 6 months prior to that, so from March to September 1994. In that period, you can see that quite a steep increase in the 5-year swap rate. And in fact, over that 6-month window, the swap rate increased by 1.65%. which is a pretty significant move, and obviously that's way more than that it increased before or after that sort of window, and that pattern has actually been repeated in the other 4 rate hike cycles that we have graphs for there in 1999, 2003, and 2006.
Okay. So if we're seeing this in the UK, does something similar happen in the US? If somebody was to go into the US markets, have they missed that boat with the Fed having flagged so vociferously, I suppose, or frequently, if nothing else, that the rates are likely to move there?
I think in the US, not necessarily. I mean, the rates have been certainly going up in the shorter term. I think in the last month or so, US swap rates have increased quite significantly. But I mean, in the current climate, there's a little bit of up and down going on because there's certainly some global risks there, and there's some uncertainty in whether rates will be raised or not. And I think it's fair to say the US or the central banks generally will be cautious in raising rates. We've spoken about asset prices and their vulnerability to increases in rates. Mm-hmm. And how that can be compounded by financial market fragility. Yep. So I think you will see potentially a little bit of caution in terms of rates going forward. Mm-hmm. In terms of corporates as borrowers, they certainly should be aware of what possibly, I guess, could happen. Okay. So are there any final words of advice that you might like to give corporates? So thinking about interest rates and the market and what's likely, well, not necessarily what's likely to happen, but what they should be doing? Well, I think the first thing is understand your risks. So as a corporate treasurer, make sure you understand your risks properly. Seek advice where necessary to help you understand the risks of your business. Secondly, I would say put in place a long-term hedging strategy. Mm-hmm. Thirdly, think about managing your execution in terms of what trades you do want to put on. And fourthly and lastly, just be prepared for what might come. Be prepared. That's great motto. I think every treasurer should have that above their desk, be prepared. Okay, Nick, on that note, I'd like to thank you very much indeed for your time this morning. That's been very interesting, very informative. We hope that you found this webinar interesting. Please do take the time to fill in the feedback form. It's very helpful for us when we're preparing for future events. The webinar will be up on the website, the ACT website, in the next couple of days, and you can also find on that website details of further events such as the Cash Management Conference, which is in February of next year. Slightly different topic, but it's normally very, very interesting. Finally, once again, say thank you very much indeed to Nick for your time. Thank you to Lloyds Bank for sponsoring the event, and goodbye. Goodbye.